What's going on, everybody? This is Kevin Lau here for another Whiteboard Fireside Chat. And today we're going to be talking about stock market volatility. All right, we've got a big election coming up in a couple of months. We've got a really big meeting with the Fed here in just a day or two. Are they going to cut rates and by how much? We've got these question marks around, are we going to have a soft landing or are we going to enter into a recession? Okay, there's so many unknown factors and the market doesn't like uncertainty. And I've been starting to get some of these emails. I've been starting to see some of these emails come across my desk. Hey, should we wait out until after the election, or should we wait until after the Fed makes a decision about interest rates to get back into the market? And I just think this is a fool's errand. Trying to time the market, it's nearly impossible to do on a consistent basis. And sure, you might have a winning streak. You might get lucky, 3, 4, 5 times in a row. But then that last time when you make it wrong, it's going to erase all of those potential gains that you had by guessing right. So don't do it. That's just my plea to you is let's start with the unemotional facts, okay? And I'm going to show you what the S&P 500 historically has done and from a performance perspective. And I'm also going to break down how feelings around what you think the market is going to do is your worst enemy, okay? You don't want to bring feelings into the investment management conversation. So without further ado, why don't we jump into the whiteboard? And yeah, I mean, the title of this one, volatility is healthy for the stock market. Listen, the S&P 500 has returned 10.5% historically speaking, okay, for more than a decade, okay? But if the S&P 500 was just giving you a guaranteed 10.5% every year, that's not how the markets work, okay? There would be no risk involved to investing, and when there's no risk, there's no potential reward. Okay, you're talking about investing in, let's say, a treasury or a CD, which those are going to be yielding closer to 3.5, maybe 4% historically speaking. Okay, so if you want no volatility, go to safe money, go to CDs, go to money market, go to cash. Okay, but if you're really wanting to invest for your retirement, protect against inflation, make sure you don't outlive your assets, you're going to have some money in the stock market. Okay, so how is that going to impact your portfolio? Well, first let's look at the historical price of the S&P 500. This one's a little old. This chart's a little bit old. Okay, but as you can see, the graph is trending in a positive direction. Okay, over these in this case 60 years. Okay, the S&P 500 has generated a positive net rate of return of, again, roughly 10.5%. Why is my boom? There we go. There we go. So it's trending positive, all right? But it's not a straight line, okay? We've got some blips on the radar here. Mainly look at this, 2000. First of all, look at this period. From 1970 to 1990, kind of muted returns, if you will. And these were the 2 decades, by the way, where international stocks outperformed U.S. stocks. Okay, so just keep that in mind. Generally speaking, when you're in high interest rate, high inflationary environments, it's more plausible that international stocks could actually make some headwinds and start to see some outperformance in international stocks. So I guess my first point is don't discount international exposure just because the S&P 500 has been the top dog, since 2000, since 2008. I'm sorry, since 2000, since 2008. So if you look at this chart, we've got some blips on the radar here. Look at the tech bubble. Tech bubble burst here in 2000 to 2002. And then we've got the major financial crisis, the Great Recession of 2008, where the stock prices went down. Okay, and then we had a little bit of a blip in the radar here in 2018. That's probably what that is right there. We had some conflict with China. Oil supply was a big concern. And then we had 2020. We had the pandemic where the market dropped roughly 30% in about an 8-week period. So we've had some blips on the radar. So this is normal. Okay, this is a natural part of investing. But ultimately, if you just stayed invested, your stock portfolio is going to generate an average rate of return of 10.5% each year. Okay, if you're just in the S&P 500, which again, not recommending you're 100% in the S&P 500, it's definitely prudent to have some other diversification within your portfolio. Okay, but then I wanted to look back historically speaking. How many years did the S&P 500 generate 10.5%? And I think it stemmed from, this. I think there was a game where LeBron James he played in this past season, and he's been in the league for a long time. Okay, I think 20 plus years now, maybe 21 years, and his average his average stats. Okay, we'll call it his points per game, his rebounds per game, assists per game. Let's call it he averages, let's say, 25 points a game, maybe 9 assists, maybe 9 rebounds, somewhere in that ballpark. Okay, don't hold me to those stats. If you're a big basketball fan and I butchered it, sorry. But there was a game that he played this season where he actually scored 25 points, 9 rebounds, and 9 assists in a game. He basically hit all of his averages in a game. That had never happened before in his 20 plus year career. And how many games are in the NBA season? I don't know, like 80 plus. Okay. So in a 20-year period with 80 games a year, he's never done that before. Okay. And that's kind of like how the S&P 500 does. Okay. While you may see a 10.5% rate of return, you can look historically speaking, this goes back all the way to 1984. So about a 20 or 40-year period. I don't see any years where the markets return 10.5% exactly. Okay, we've got a 2004 10.88. We've got a 1993 10.08. Those are the two, I think, that are the closest to a 10.5% rate of return. And really, in reality, the S&P 500 is a lot more volatile than LeBron James. Although LeBron James is one of the greatest basketball players to ever play, and his play is very consistent. Okay, so even though he's not hitting exactly his averages, maybe he's doing 30 points in a game and 12 rebounds and 12 assists, and then the next game maybe he's at 22 points and 7 rebounds, 7 assists. You get my drift. It's not going to be too far off his historical average. He's very consistent. The S&P 500, not so much. You're going to have years like in 2008 where the S&P 500 is down 37%. Not good. Then you're going to have years like 2000 to 2002. The S&P 500 was down -9, -12, and -22%. And all of a sudden in 2003, plus 28, right? And then look in 2008, -37. What is it followed up by? Positive 26. Look back into 2022. This was our most recent bout of volatility when we had the triple bear market. S&P 500 was down, and this says 18%. I think it was more like 25%. Maybe that was before dividends, but 25%, let's call it. And bonds were down 12% that year, and cash was also returning a negative yield net of inflation. So what is 2022? What is 2022 followed up with? Positive 26%. Okay. And you can really go down the board and look at any time where we have a bad year in stocks, it's kind of followed up by a pretty strong year thereafter. Okay. And so, where this comes from for me is this old quote of Warren Buffett that I love so much. It's be fearful when others are greedy and greedy when others are fearful. Generally speaking, if we're going through times of volatility, like in 2008, like in 2000 to 2002, like in 2022, people are not optimistic about the stock market, okay? But when people are fearful, that's when there's opportunity, okay? That's when things are on sale because likely they sold out of the market, they were running for the hills, flighting to safety, so to speak. Now there's opportunities for buying in the stock market, okay? And this chart nails it, this consumer sentiment index. And I've referenced this chart before. This one actually stops in 2022. But what's so interesting is that, you think about these average returns of 10.5%, okay, with the S&P 500. And we already just saw in that last chart, typically when you have a down year in stocks, it's followed by a year or 2 or 3 years of really strong performance, sometimes longer. I mean, after 2008, look at this. Positive 26, positive 15. Yeah, okay, positive 2 kind of flat, but then positive 16, positive 32, positive 13. Those are several years of very strong outperformance. And if you were sitting on the sidelines, scared from 2008, waiting to get back in the market, you missed out on a significant bull market, okay? And this chart nails it. This chart really summarizes Warren Buffett's quote, the be fearful when others are greedy quote, and greedy when others are fearful, okay? So you can see, generally speaking, when consumer sentiment is high, when investors are feeling optimistic about the market, those are these points here. Oops. Sorry. Those are these points here. Okay? Boom, boom. And then what it's going to show you is the performance over the next 12 months for the S&P 500. So in 1972, consumer confidence hit a pretty high point there, okay? So the average of consumer confidence, this index, how they benchmark it, is 85.6. So we were above this benchmark. We were into the 90s. Let's call it 95. Hey, you know what happened? So investors are feeling optimistic. What does the S&P 500 do over the next 12 months? -6. Oh, hey, we're feeling optimistic again. What does the S&P in 1977? What does the S&P 500 do after the next 12 months? +1.2. Oh, okay, that's a bad example. January 2000, investors are feeling very positive or optimistic about the markets. -2%, +4.4, -4.2, -2.7. And yeah, okay, we had a +29. But the point is, generally speaking, if people are super optimistic about the market, it's actually a reason to be cautious, okay? Because likely the market is forward looking, okay? The market is looking ahead of the game. It's not looking at past performance, it's looking at expectations, okay? So look at 1975. Consumer confidence kind of bottomed out here. Look at the S&P 500 returns, +22%, well above the average historical return of 10.5. Look at 1980, also reached near a bottom, +20% over the next 12 months, +29, +32.8, +14.2, and so on and so forth. Look at this, +43.6. And so it measured these average returns of the S&P 500 after you hit a peak versus a trough, and this is all the evidence you need to see. A 20% outperformance when you hit a trough relative to a peak. That to me illustrates exactly why behavior, you need to remove emotion from the process. You need to remove behavior from the investment process. You need to have an investment policy statement that you can stick to over time and manage to that investment policy statement that's beautifully aligned with your retirement income goals. Not what some talking head is saying about the interest rate environment, not what some talking head is saying about US stocks versus international stocks or small caps versus large caps. Pick an asset allocation that aligns with your specific goals, your specific risk tolerance, and manage to that. And do the best you can to cut through the noise. When people are not feeling good, you're going to hear a lot of that from the media. Okay, the media loves this kind of stuff. In 2020, or no, look at this. In 2022, when we hit I think it was a 40 or 50-year low in this consumer sentiment index, June of 2022. 2023 was a pretty darn good year for stocks, if you remember, +26.29%. Okay, so this held true once again. This ended in 2022. So when consumer confidence hits a low point, the media is they're sort of selling the fear. They're sort of selling, hey, stocks are bad. Typically the market has come down a little bit, and that's why there's so much buying opportunity when you hit these troughs. But no one's feeling optimistic about investing, and the media is all about that. They love when people are fearful. My mother-in-law loves to say, if it bleeds, it leads, okay? And this is exactly when you need to cut through the noise, especially if you have a big election coming up in a couple of months. Emotions are going to run high, and you need to do the best you can to avoid derailing your investment process because how you feel about the market. Because really how you feel about the market is contradictory to how you should actually act. When people are fearful, you should be looking at buying opportunities. When people are optimistic, you should look at rebalancing, taking some of those gains off the table. So you saw that chart that ended in 2022. Okay, and so consumer confidence, like I said, hit a low point around here. And, it's kind of traded a little bit sideways. So, there's nothing really that jumps out to me here other than it's been going up and down. There's been some high points and some low points, because there's so much uncertainty with interest rates and inflation and how quickly we're going to get back to the 2% target from the Fed, how fast are they going to cut, et cetera, et cetera, et cetera. But the point is, the market is already pricing in those rate cuts. We came into 2024, I already mentioned the market had priced in 3 rate cuts beginning in March. Okay, so when that didn't happen, we saw a little bit of volatility, but then we saw some positive news about inflation. So you're going to continue to see the markets trade a little bit sideways and having some ups and downs with the market. This is completely normal until we sort of set into this new normal. We have some more certainty, and then we could absolutely see, a run up in stocks. But again, never invest on what you think might happen or how you're feeling. Invest based on your IPS, your investment policy statement that's beautifully aligned with your specific your specific goals for retirement income, your specific risk tolerance, your specific risk capacity, and stick to that. Rebalance to that over time. Okay, manage that particular risk. And if you want help with that, find someone you can trust. Okay, find someone who can look at your portfolio, give you some constructive feedback on your asset allocation, and if that's in alignment with your specific objectives and what's important to you. And then if you need to make an adjustment, make an adjustment. Okay, but don't sit there, you know, with the news on all day. I'm not going to name, the networks, but don't sit there with CNBC all day, just watching what these talking heads are saying, because that could impact your emotions. They are experts. They are professionals when it comes to, pulling at the heartstrings, selling fear, and that's not how you want to be managing your investment portfolio. That's it for this fireside chat. I hope you guys enjoyed it. And if you guys have any questions about the markets right now, if you guys are concerned about what's going on, if you're wondering what other people are doing right now with their portfolios that are preparing for retirement or in retirement, drop me a comment below. Would love to see your comments. Would love to respond to those comments directly. And if you want to hear about another topic, if you got a topic in mind that you'd love for me to break down on the whiteboard, make sure to send me a message. Okay, send me a DM. And also make sure to like, share, and subscribe with someone else that's going through a similar situation as you, that's approaching retirement, planning for retirement, wants to make work optional in the next handful of years or 10 years or so. And we'd love to impact them the same way we're impacting you. So that's it for today, everybody. This is Kevin Lau signing off.